So I'm going to be talking to you about Forex as well, and give you a little bit of a different take on how we at Pristine and myself look at the Forex market. I'm also going to give you a little bit of background as well around Forex, why it is such, in my opinion, a wonderful tool or instrument to trade outside of just, maybe equities, options, futures, whatever the case may be. You can trade Forex exclusively or as a way of diversification. All right, so before we begin, just a little bit about me. This is a picture of myself with my daughter. I've been with Pristine longer than 8 years, but 8 years as a trained trader and investor. Graduated from, as Reed said, Pace University, the Lubin School of Business, and I knew what the markets have to offer because my father is president and CEO of Pristine, so I kind of just fell right into trading from a very young age, knew what there was to make, and just dove headfirst in. Since then, as you can see, I've become a member of our research department and teach a variety of our courses. But before we go any further, just our quick standard disclaimer: it is possible to lose money trading, and more than just possible. If there's anything that I can guarantee when it comes to trading, it is, give me one quick second here, it is that you will lose money. Right? If there is any guarantee, it's that you will lose money. And so that's part of any business. And if you own a business, if you have owned a business, you know there are costs to doing business, and there is an overhead involved with operating a business. Trading is no different. Losses are part of the business. They should be viewed as, kind of an operating cost, so to speak. Video is flickering. All right, give me 1 second. All right. So, like I said, it's possible to lose money. You will lose money trading. The goal is to keep your losses small while maximizing your reward, and you do that through education, right? Which is why you guys are here, is to learn a little bit of something and see what makes sense for you. But why should you trade Forex? Why should you even consider it as a potential avenue to go down? Now, I don't know everybody's experience levels. I don't know how familiar you are. So if you guys could just give me, a yes if you have experience with Forex, no if not. It'll give me a better idea for the group. So go ahead and do that now. And like I said, if you don't have any experience with Forex, I hope you seriously listen to what we're going to talk about here, because as you'll see, it really is no different than any other type of trading out there, but in my opinion also has a tremendous upside to it. All right, so I see a kind of a mixed bunch here, a couple yeses, some nos, which is probably to be expected. All right, so why should you trade Forex? Well, first of all, the liquidity. The liquidity is second to none. It is the most liquid market in the world. When you're trading the Forex market, there is nothing that even comes close to matching the liquidity and the sheer number of daily transactions that take place. Just to give you some perspective, the U.S. stock market does about, we'll round up and say $200 billion in daily transactions. The futures market does $437 billion in daily transactions. When it comes to Forex, you're talking $5 trillion in daily transactions. It truly is a world market. So you don't have to have any worry or concern about getting in or out at any time of day or night, no matter where you are. When it comes to trading Forex, and this is going to be somewhat of a review for those who are familiar, but for those of you who are not familiar with Forex, when you trade an equity, you're trading a specific symbol. here we're trading one currency against another. So for example, if you're looking at both the euro and the US dollar, that would be quoted as Euro USD, right? EUR USD, which means you're trading the euro against the dollar. In other words, if you were to take a long position on this pair, you would be taking the euro long and shorting the dollar. And vice versa would be true if you were to sell this short. You would be shorting the euro and taking the dollar long. So that gives you kind of a basis for what it is we're going to be looking at in the examples going forward. Now, Howard's saying with that kind of money, well, can they ever manipulate the market? And, you know, honestly, any market can be manipulated. That is one of, I think, the many misconceptions about Forex is that it's looking to pick off the little guys. And to a certain degree, it is true. I mean, I'm not going to say it doesn't happen. It happens anywhere that you might look to trade. But if you really know, in my opinion, what to be looking for, if you are focused on the right support and resistance levels, you can significantly reduce yourself getting caught in those types of situations where you feel like you're getting, you know, headhunted, so to speak, or your stops are getting hunted. So we'll talk about that as we go on. But it really comes down to knowing the major support and major resistance areas, because I'll tell you, it's unlikely that the major players, the big banks, it's unlikely that they're going to run stops that are below key support levels or above key resistance levels if their intention is to not take it in that direction. So in other words, you're not going to break under an area of major support unless the big guys, they want to take that particular pair lower. So like I said, we'll talk more about that. It is also a true 24-hour market, and I say true because with futures, it is a 24-hour market, but it's not really that active all 24 hours. There is quite a bit of downtime with the futures market. When it comes to the Forex market, it truly is 24 hours, so it's very accommodating to those with other jobs, to those who may need to be having the flexibility to adjust their schedule from time to time or more regularly. So it's very accommodating in that way, especially seeing as how you'd be trading off of hourly and 4-hour charts. I mean, you could even go and trade daily time frames as well. So you can get into a trade, say at 8 o'clock in the morning, and you may not look at it again until noon or later on in the day. So it's very, as I said, accommodating in that regard. And because it's a 24-hour market, the action is more seamless. You really are not going to be having to deal with gaps from one day to the next. Now, there can be some kind of news event that comes out or some kind of rate announcement that comes out where you can get some volatility that may cause a bit of a gap. But generally speaking, you're not going to see those gaps like you would see in equities from one day to the next. This allows price action to be more seamless and for the technicals of the chart to be adhered to in a much more clear and quality manner. As I already said, there's enough liquidity on all major pairs to get in or out at any time. It really is not an issue. You might get filled into a long position at 4 in the morning, and as the trade continues to work in your favor, you may hold that into and through the 4 o'clock U.S. session close, and then you might end up getting out of the position at 11 o'clock at night, or maybe very early in the morning. The point is, you don't have to worry about getting in or out at any point of time, day or night, when you want, where you want. especially on these, as I said, major pairs. But here's just a visual breakdown of the different market sessions. We've got the London session that gets going around 3 in the morning and lasts all the way up until 11 o'clock, and that's when things start to wrap up. 12 o'clock, things start to slow down there. So that's the London session. As you can see, it overlaps with the New York session between the hours of 8 o'clock and into 12 o'clock, 11 o'clock. That overlap, which you can see here, this is the most volatile time that the Forex market is moving. That's when the volatility begins to peak generally. And I don't use the word volatility in a negative way. Volatility is something that can be very positive. At times, it may not work in your favor. So the volatility is just a way of us being able to explain that the movement generally is best during this overlap. That's not to say you can't get opportunity outside of these times. In fact, many opportunities do happen during the London session only. You know, so as I said, 3, 4 in the morning, 5 in the morning, you'll start to see some really good movement. During the Sydney session, as well as the Tokyo session, things do generally start to slow down. But what I have found is it's during these times, during these sessions, that not only can opportunity develop and trigger, but that's when you start to see a lot of patterns materializing that you can then set up trades for the following day. In other words, one of the things I look to do is I'll look and see, okay, what's setting up around 11, 12 o'clock at night, and then I'll set my orders up with the expectation that they'll trigger when the London session gets going. You know, so I'll be sleeping, the order will trigger, and then I come to the desk the next morning, and hey, I'm already making money. Or, you know, sometimes they get stopped out. That's just how it goes. It is what it is. But more often than not, you know, it's working in my favor. So again, there's always opportunity, whether it's developing or whether it's underway. In addition to those things, the next big advantage is the lower cost to trading. There are typically no commissions as it's built in. I mean, there's a cost to entering the position. There's a cost to placing the trade. So whether you call it commission or spread kind of gets into semantics, but there is a cost to entering the trade when it comes to Forex, just like anything else. However, there is no trading fee, platform fee. There's no data fee. And there's no exchange fees. So where you would be exposed to these costs, this overhead with equities, you're not going to have to deal with these additional costs, which can add up over time with Forex. Now, before we start looking at charts, understand what a pip is. And like I said, for those of you who know Forex, you know what this means. For those of you who don't have much experience or very little, a pip is the smallest incremental movement that a Forex pair can make. So basically, we're looking to capture pips. On a standard lot, 1 pip is $10 for the average, you know, US dollar pair. If you're trading a mini lot, 1 pip is the equivalent of $1. So if you have a 10 pip move in your favor on a standard lot, you will be up $500. If you have a 50 pip move up in your favor on a mini lot, you'd be up $50. Right? Just so we kind of get an understanding of the pip translations into the dollars and how that all works. The next thing I want to talk about, though, is all of the subjectivity that exists out there, you know, around Forex, around anything that many people look to trade. And I want to ask the question, do you really need these tools? Do you really need a MACD? trend line, RSI, fib retracement levels, stochastic, Bollinger Band, Elliott wave. Do you really need these things? It is my opinion, as well as the opinion of Pristine, that you do not, because they're all based on price. In other words, if you can read price, there is nothing that these tools can tell you that price has not already said. It will always be after the fact. Price is always going to be the first thing to give you the signal. Many traders like to try and use these as confirmation, but you know what ends up happening is you end up getting a chart that looks like this. You start saying, well, yeah, I'll use my fib retracements, but let me also put a RSI on here, and I'll use some trend lines and Bollinger Bands. And you start to get into other things as well, and before you know it, you've got a chart that looks like this, and you're thinking to yourself, how can I go wrong? Right? With all of these tools, with all of these things on the chart, when I get a signal, I'm gonna be golden. But as we know, or as you will come to find out if you are struggling with what I'm saying here right now, it's very rare that everything comes together in the same way. In many cases, they're often conflicting one another. So you have to try and sift through and say, okay, well, what do I really want to do here, right? This says to go long, this says to go short, this one's saying to go short, this one go long. So you basically say, okay, well, what is the overall consensus, and then hope for the best. What you want to do is get away from this. You want to focus on what truly matters, which is price, multiple time frames, price support and resistance. Not when I say support and resistance, I don't mean from a fib retracement level, I don't mean from a trend line. I'm talking about price support and resistance, where traders put their money into the market because that's where they're going to act on. I could care less where a fib retracement is, but if it lines up with price support, if it lines up with where traders have put their money into the market in the past, then I say, you know what, this is an area I want to pay attention to, not because of the fib retracement, but because of what that lines up with. So to a certain degree, these subjective tools that I was just showing you are mirages. Right? They are masking what is really going on. They are hiding the truth in a sense. So I'm going to talk to you today about how to recognize that truth, how to see the charts and read the charts in this way, where you're just looking at price and one or two moving averages, because this is quite honestly all you need. Here on this chart alone, I'll just do some drawing, right? Yeah, we were in an uptrend here, right? Price is moving higher. That is not a very good color. I don't know if I can change that color though. Oh yeah, there we go. Hold on. All right, so price is moving up, right? We then get a new high that fails. It results in a topping tail. This is a wide range bar down that continues to move lower and breaks below this support level. Once we break below this support level, I'm looking to get short on the next retracement or breakdown. So I could have played this little triangle type of thing here. I could have played that short for a quick move. I could have played this retracement back up into the resistance, right, to the left, where we get a topping tail. Topping tails indicate that supply has increased. That is not something you want to just, ignore. That is not something you want to poo-poo. If you get a topping tail at resistance, it tells you that traders are taking action here. And if it's forming in alignment with the trend, if it's forming in the direction of the trend, you want to be looking to sell this short. Right? You want to be looking to sell a short under this area and riding the move down. Now, believe it or not, this is the same exact chart as I just showed you, where we had all of that subjectivity on it, all those subjective tools. I can go back here real quick because I don't want to spend too much time, and I'll get rid of all that stuff here. This is the same chart. This is a chart of the Euro US dollar on a 4-hour time frame. Here it is, same chart, Euro US dollar, 4-hour time frame. It looks a lot better like this. So we're going to continue to look at some examples where this is all you really need. Here, pound US dollar. This is a daily time frame. And guys, what I'm about to start talking about, it pertains to any time frame that you're looking to trade. It doesn't matter whether it's a daily, a 4-hour, a 15-minute. It's going to work regardless because we're basing our decisions on the charts, on, in other words, human emotion, which does not change. Fear and greed is experienced in the same way regardless of the time frame you're looking at. So here we are in a downtrend, right? Price is trending lower, and then we begin to go sideways. As we're going sideways, notice what happens here. Notice what happens here, over here, right? These green candles as well, and this one over here. It seems insignificant. You know, a lot of people won't put very much attention on these candles which I have just highlighted. However, it's important that you understand what is happening there. So let me ask you guys this question. Those green candles, do they have any follow-through? Yes or no? And when I say follow-through, what I'm asking is, do they result in price moving higher? Right? Because each of these green candles is a bullish bar. Bullish candles suggest price should continue to move higher. So do these candles which I have highlighted follow through? No, right? As you guys are saying, no, they don't. So put that within the context of a downtrend. Green candles having no follow through within a downtrend tells me what about supply? What does that tell you guys about supply? Green candles having no follow through in a downtrend. Get a little participation and interaction here. Right? It tells us that supply is strong. There are less buyers. There's not as much demand. We've got overhead supply. Exactly. So in other words, the bears are in control. And we want to be looking for, do you want to play this at the top of the range? Right? Would you want to play this short at the top of the range? If so, you've got every right to do that. You've got every right to sell this short every time it comes to the top of the range. Or wait for it to break under the bottom of the range, short this breakdown. Play this move lower as well. Or instead, right? Remember, look, this topping tail, that was a very bullish bar prior to completion. But when this candle finished, you've got a topping tail indicating that buyers have gotten trapped. And once again, this is happening in a downtrend. This analysis would have produced a move of over 400 pips. So on a standard lot, you're talking over $4,000. Or if it's a mini lot, it's $400. So either way, you're making money. Here's another example, and some of these examples, the majority of these examples that you'll see will have the entries on them as well as the stop loss, whether it's trailing it or where it was originally placed. So you can see that these are not just charts that I've selected and decided to mark up because it's going to work for the presentation. These are trades that were actually taken, and I just took snapshots of them. I took snapshots because I want to know, I want to have a history book, so to speak, of trades that I've placed so that I can go back and review the ones that worked as well as the ones that didn't work and learn from them and get better from them. So as you can see, the entry and the stop loss on the chart, this is the US dollar yen, which really doesn't matter, but if you wanted to know, that's what it is. These patterns work regardless of the pairs because, again, we're trading human emotion. Do you use candlesticks with the moving averages? Yes, exactly as you see it here. Now, moving averages are more of an amplifier or something that helps speed up my analysis. Ultimately, the decision to place a trade or not, though, comes down to the chart. So as you can see, the entry was here after price had a beautiful wide range bar. This told us a lot of traders were committing to the long side. Buy the pullback, right? Here it is. You buy the pullback, you get in, and just let the trade work for you. This is a 4-hour time frame, so this is 8-12 hours later. You're just sitting back, relaxing. Think about what you could do in 12 hours time. And this is one of the things I really like about Forex is the time that it allows you to devote to other things. Maybe you have another job and you can't be in front of the screen. As I said, you can set up an order to enter this trade before you go to work. 12 hours later, you're still in it. It's moving in your favor. You're up, almost $1,000, almost $100, depending on the lot size you're playing, and for very little work. I mean, this is a no-pain gain. These are the 8 and 21 EMAs. 8 and 21 EMAs. So look at it. Well, you could do that as well. Howard is saying instead of looking at the pairs, you can look at them on an individual basis and then look to play the strongest trend against the weakest trend. And you can certainly do that as well. But there's only there's not a tremendous number of pairs that you're going to be looking at. So I look at about 24 pairs in total, and I can have them all up on my screen at once. I have 4 monitors that I'm looking at, and I have them all across all 4 monitors, and I can see everything there is. So I like to see the patterns on the pairs, because even if you have the strongest one paired against the weakest trending currency, it doesn't mean that it's going to result in a beautiful pattern. Yeah, if you send an you can email me. It's kurt@pristine.com, or I have an offer for you guys at the end of this to email counselor@pristine.com for a free ebook. And so either way, we can get that to you, no problem. Why the 8 and 21? Are these the best for the 1 hour? I mean, I feel that they work very well. There's really nothing special about them. It's just the ones that I feel work the best. But at the end of the day, you just go with what you feel looks the best, whatever is most aesthetically pleasing. Realize there is no perfect moving average, whether it be a simple moving average, an EMA, whatever, VWAP. There's no quote-unquote perfect moving average. So you just have to decide which ones you like the best and then commit to it. So Forex done the pristine way includes but is not limited to multiple time frames, trend analysis, an understanding of price support and resistance, right? The use of subjective tools but in an objective way. So like I said before, if I'm going to look at a Fibonacci retracement level, I'm going to put it within the context of what's to the left. If that fib level lines up with price support, okay, good. The odds of that area holding are much better. If I get a pullback to a fib retracement level that does not have price support to the left, I'm not going to take it because I have found that that's more likely to fail. So here are some other examples. I think I only got about 15 minutes left, so I've got a lot of examples. I'm going to go through them rather quickly, but not so fast that you get nothing out of it. Once again, here you can see we're starting a new uptrend, and let me just get my pen out. Right? Price breaks out above this resistance. I want to look to play the next pullback long. Here it is. Right? Obviously, I got into this one a little late. I saw it a little late, whatever it was. I got a bit of a late entry. It happens, right? I mean, we're human. It's not like we're always going to get it where we want. But in any case, you get into this, you continue to manage this up. You can see it's holding the 8 EMA very well. Consolidation here. At the point in time where I captured this, which was right here, right in here, you can see it's up 81 pips on a 20 pip stop. So in other words, if you were risking $200, you're up 800, 4 times your risk. 4 times your risk. So, I mean, you're up 4 times your risk, whatever you'd be risking, but it's more about the process. And I say this all the time to those who I speak to. We do this to make money, but the more you focus on the money, the less of it you're going to make. You have to focus on the process. You have to focus on the plan and executing it exactly as you have it laid out. And if you need to make tweaks along the way, then do that. But don't focus on the money. You have to focus on the quality of the setups, making sure you're taking the best of the best. And if you do that, the money's just going to fall into your lap. But look, not every setup is going to work. I'm not going to sit here and say every pattern I take is a winner, because that's not the case. In fact, I got caught earlier today. I bought a breakout on US dollar yen off the 4-hour time frame, and it ended up coming back in. It stopped me out. But then I was able to get into another trade on Canadian dollar yen, and that one started working in my favor. That was a trade I recently got into. I'll show you another one that I'm in currently as we go on through the presentation. But again, not every trade is going to work. It's not even about trying to get every trade to work. It's about being objective. And when a trade doesn't work, knowing what implications that has on the chart you're looking at. In other words, if you get stopped out, does that mean that the trend is changing? Or does it mean that it just needs to pull back into support a little bit more before it can move higher? As you can see in this example, it was the latter. It just needed to pull back a little bit more before it was able to move on up. But these are questions that you need to know the answers to, because if it does pull back and breaks major support, then you want to start shifting your buy beginning bearish opportunities. So just because you get stopped out doesn't mean that you were wrong. It may just mean you got the wrong area, or that it needs a little bit more time. Euro yen. As you can see, the trend is down, little retracement. Now, this retracement, by the way, right here, this little wave to the upside, whatever you want to call it, this higher high, this was not, in my opinion, bullish. Why? Look to the left. Right? It fell or it moved up right into resistance where it had broken down from. This is what's known as a bear flag that formed a lower high on the daily chart, right? So it begins to move down, consolidation over here, topping tail, you sell it short on the breakdown, and there it goes. Beautiful fall. Do you avoid taking a trade if there is long candles or spike prices? I wouldn't necessarily say that I would avoid it if there's long candles. I mean, I am looking for good quality setups. So if there are spikes or a lot of tails opposing one another, I will not take trades in that kind of environment. But if I have a good quality trend, whether it be up or down, or even a good quality sideways trend, I I am an equal opportunity trader, so I'm not going to single anything out. If there's a good opportunity, I'm all about it, but I will stay away from things that are more overlapping in nature and produce less quality. But it really doesn't matter whether you're going long, short, anything. This will work. Here is a trade I took on Euro US dollar, and once again, entry was here, played it up till here. Now see, this one I didn't expect was going to be as strong as it was, but I still got a good chunk of the move out of this. You got a 91 pip move on about a 45 pip stop. So roughly speaking, you made about 2 times your risk. Or if you were trading a standard lot, almost $1,000. If you're trading a mini lot, almost $100. And again, the moving averages are the 8 and 21 EMA. Do you block off 30 minutes before and after red impact news release? Generally, yeah. I mean, even an hour. If it's an hour before, I'm not going to do anything, especially if I'm trading off of an hourly or a 4-hour chart. If I'm not in a trade within an hour around that news event, I won't do anything. US dollar, Canadian dollar, another example of a breakdown. Price is in a downtrend here, it's moving lower. Sell it short right there, back down to this prior low. You can see the price target I had here. This one actually did not reach that target. It came pretty darn close to it, but still a beautiful move lower, and the trail stop would have gotten you out with some nice profit anyway. Do you bargain, i.e. let price retrace before entering? I will, right? I will. I mean, really, the price patterns tell me what to do. So I listen to the charts. I let the charts speak to me and tell me what to do. So yes, if I can get a bargain, as you're putting it, I will be more than happy to take it if we get that retracement. But sometimes price is going to tell you it's not going to retrace. And so you have to choose to either play the breakout or breakdown, or don't play it at all and risk the possibility of missing the move, which is okay as well. I mean, it's whatever your plan tells you to do. I want to take a quick break, though, before we go and look at some other examples and run through 10 misconceptions when it comes to Forex. This is not a get-rich-quick environment. Some people may have you believing that, some people may have marketed that to you, but it's not. It's like anything else that you're going to look to trade, equities or otherwise. You need to put in the work to make it work. There's no such thing as, or at least there's, if it's too good to be true, it probably is, right? So I'll just leave it at that. Forex is for short-term traders. No, I mean, I'm showing you examples of 1 hour and 4 hour time frames. In fact, I heard a little bit of the prior guy's presentation. He was talking about daily and monthly time frames. So no, it's not just for short-term traders. It's for those who need to have some longer-term options available, but maybe not want to have to worry about gaps. So when I look at Forex, I almost look at it as the best to both worlds, from intraday trading as well as swing trading. There's kind of a beautiful synergy that happens with Forex where you can do both. You have the ability to intraday trade off of an hourly or 4-hour chart, but the luxury to hold that overnight without the worry of a gap. Do I switch to higher or lower time frames before entering the trade? No. I mean, I'll look at the larger time frame to confirm that I'm not trading against it, but if I have a pattern on the time frame I'm looking at, then that's good enough. If I can refine it, I will, but I don't go out of my way to worry about it. The market is rigged. I kind of addressed this one earlier. I wouldn't say it's any more or less rigged than anything else, especially if you know what you're looking for. You can be right every time? Obviously, no. You can't be right every time. Of course, the goal is to be right every time, but there are things that happen outside of our control which prevent that from happening. It's the way it goes. That's why we have stops in place so that we can protect our capital. Others say it's easy to make money trading news. Not the case. You can get lucky trading the news, but I wouldn't say it's easy to develop a trading style that evolves simply around trading the news. The more trades and more pairs that you're looking at, the better it is. Maybe, maybe not. It really depends on your style. I wouldn't say that that's necessarily a misconception, but for the majority of people, less is more, especially in the beginning. Predicting the market is how to make money. To a certain degree, absolutely. Right? We're always predicting or speculating to a certain degree what the market is going to do next. When you have an objective approach to doing so, that's when things become much more clear, and your odds of success are much greater. You go from gambling to trading professionally. The more complex the strategy, the better. As I said a moment ago, I feel less is more. Money management means placing a stop. That's just where it starts. Money management is more than that, and we can get into that. And if you decide, look, I teach a course. I'm not going to pitch it to you here right now, but I do go into much more in money management there. And success in other markets does not equal success in Forex. Honestly, using the Pristine method, it does. Because it's a clear, objective approach, as I've shown you here today. There are other strategies that may not work as well with Forex, but I'm not, I haven't been exposed to those, so I can't speak to that. What I can speak to is how trading Forex relates, and the Pristine method relates to trading other things. If I wanted to tomorrow, I could go and start trading equities using the same exact concepts and method and do so successfully. So there's a seamless transition there. Here's another trade, pound yen. You can look at it here for a moment. I'm going to just catch up on some of these questions. Do you look at smaller time frames to get out before a reversal? I do sometimes. If I'm getting close to my profit target, I will look to tighten up my trail stop on a smaller time frame. So yes, I will look to do that, as I said, when approaching a targeted area. Do you insert the stop loss all the time? And never skip? Yeah, no, I'm always going to have my stop loss in, right? I'm always going to have a stop loss in. I'm not one that's going to be concerned about, oh, can they see where it is? Because I know based on where I'm putting it, I mean, the pattern, it shouldn't be violated. It should not be violated, plain and simple. So I don't worry about that. Do you trade base divergence, price? No, I don't. This is how I trade. You see these charts? This is how I trade. Price, moving average. That's it. Right? So again, here's another one. US dollar, Canadian dollar, entry 23.79, which was right up and took it on the way down. I'm speeding up here, guys, because I'm running out of time, and I just want to give you as much as I can. Here's another one, pound US dollar. Entry was over here. Nice move up. And then another pound US dollar trade we got in over here. Profit target was up here, and as you can see, it continued to move higher quite nicely, resulting in over a 100 pip move in your favor in a relatively short period of time as well. I mean, you're talking about a 100 pip move up, which is 100, almost, $150 on a mini lot, or $1,500 on a standard lot. Do I exit when the moving averages cross? No. I will hold based on supply and demand. When I see things coming into a resistance area, if long, that's where I'd look to exit. All right, so here's another trade, US dollar, Canadian dollar. I'm going to speed through this because I believe I'm done here at 4 o'clock. So let me just show. This is a trade that this is the one I currently have open, the Aussie yen. You can go and look at your charts. It's progressed a bit more from here, but this was just a more recent example as well that I had for you guys also. But special exclusive offer for you guys, as I said before, 7 steps to a good trade ebook. If you want it, All you have to do is simply email counselor@pristine.com. You can put that subject line in, Investor Inspiration Exclusive Offer, and we will get that to you. Do you trade only during London, New York Open? No, I mean, I'm looking at charts all the time. I will say that a lot of times trades will be triggered at those times during the London and New York sessions, but I will enter trades, or I should say I will set up trades, say 10, 11 o'clock at night. There might be things that set up around those times where I'll enter. So, I mean, the majority do happen to trigger around those times, but like I said, I will set up trades in the late evening with the expectation that the London session and the pickup in volatility is going to help those trades trigger and start moving for me. All right, guys, so did my best to answer the questions as they came through during and throughout the presentation, so I think I got to them all. So if not, I apologize. You can always email either counselor@Pristine, or you can email me directly, Kurt@Pristine.com. But I do hope that you've enjoyed this presentation. Hopefully you take advantage of this offer. I mean, it's a no strings attached, no credit card required, nothing, you know. Simply ask for the ebook and we'll get it to you. That's simple. But otherwise, I want to thank Investor Inspiration and Reed for giving us this opportunity. Hopefully you guys have enjoyed it. For those of you who have not been exposed to Forex before, hopefully this has at least opened your eyes to the potential opportunities that it can provide you. All right, guys, thanks again, and hopefully we'll talk again soon.